So we are going to do accounting concepts that means these are the rules that are to be followed when preparing financial statement. And obviously these ensure that information in the statement are easily understand and reliable. That is, when these concepts and rules are being followed, actually it provides a standardization of preparing the financial statement. And when all the rules are uniform, it is easy to understand the financial statement of different organization can be compared over time because the same standard is followed. Now, obviously, what are those concepts? The first one, obviously, is money measurement concept. That means we record only those transactions in our financial statement that has some monetary value. There can be transactions or assets. Those can be considered as an asset for our business organization, but as they do not have any monetary value, these are not to be recorded, like skill of the workforce, leadership quality, quality of the product, quality of the management. We cannot express these in terms of money. So these may be considered as the assets or resource, but cannot be actually recorded in our financial statements. Materiality concept, that means items those are of high value and very much significant for our business should be recorded as fixed assets or non-current assets. But the items maybe of small value or insignificant may be considered as expenses. For example, when we purchase a car, it's a very significant value and very important. Like, for example, we need to deliver the product to our customer's house using the delivery van, or we need to collect the materials from our suppliers using the delivery van, and delivery van is of very high value, so that is recorded as a non-current assets. However, for example, stationery, I repeat, stationery, those are also used in our business on a daily basis, but these are a very insignificant value. That's why these are considered as an expense and not as non-current assets. Then consistency, that means we must be consistent with our accounting practices. That means there are different ways to record transactions. Like in case of depreciation, there are different methods like straight line method, reducing balance method. So obviously we need to follow one method for a following type of non-current assets. For example, if you are buying computers and you are using reducing balance method, then obviously every year for every type of computer, we need to use reducing balance method. We just cannot change the method of depreciation every year without proper justification. Then we go for prudence concept. This is the most, I think, this is my perception that this is the most important concept. Like in every financial transaction, in every financial statement, prudence concept is highly applied. That means accountants will not be able to overstate their assets or profit. For example, if the accountant assume that the next year the profit will rise, this cannot be recorded profits unless realized. Or assets, we know that the next year the land value will rise, but we cannot write that that appreciation in value. We cannot just estimate and show that as a profit or show that the asset value has increased. But we cannot. But if losses are anticipated, it must be taken into account, such as like provision for doubtful debts. If we think that in future some customers will not pay us, so obviously we may term that as provision for doubtful debts or allowance for doubtful debts, and we must consider that loss in the current year's financial statement. Then matching concept, that means every year the expenses of the current year must be matched with the income of the current year to get the net profit. That means if there are like income prepaid, in the expense or income prepaid or owing, that should be adjusted. For example, if expense incurred but not paid, so suppose 200 is still owing, but in our income statement we must record that 200 as well, though we did not pay, because for example the total rent for this year is 1200, but we have paid only 1,000. However, these two, but we must in income statement as an expense we must record 1,200 and not 1,000. And take another example. Suppose our rent expense is 1,200, but we have paid 1,500. That is 300 advance. So currently in current year expense, we must show that only as 1,200, not as 1,500. Then business entity concept. That means our private transaction and business transaction should be separate. That means business transactions should be treated differently than private transactions. For example, office rent paid by checks, office rent debit, bank credit. But for example, house rent paid from business bank account. So obviously this is for personal use. So that should be treated as drawing and not office rent. So personal expense should be treated as drawing and not as business expenses. Therefore, we can say that business is totally treated as a separate entity than its owners. I hope you're clear, but if you're not clear, please ask in the live class. Thank you very much.